Hey everyone, it's January 2026. New year, new opportunities. But here's the challenge most people face. You want liquidity, easy access to cash for emergencies, opportunities, or peace of mind without sacrificing growth, letting your money compound at 7 to 10% plus in stocks or other assets. In 2026, with high yield savings still paying up to 5.00% APY, rates potentially shifting, and markets favoring disciplined investors, BlackRock/UBS outlooks, you don't have to choose one or the other. You can build a smart system that keeps cash working and keeps most of your portfolio growing. Today, we're breaking down how to build liquidity without killing your long-term growth, practical strategies, current 2026 rates/tools, and a step-by-step plan to start this month. If you've ever felt stuck between safe but boring cash and growth but locked up investments, this is for you. Stick till the end for your actionable 2026 plan. Let's dive in. Liquidity means quick access to cash without penalties, taxes, or forced sales at lows. Growth means beating inflation, approximately 2.7% latest, and building wealth via compounding. Why balance both now? Markets volatile, AI/tech dispersion, rate uncertainty, Fed path unclear, life happens, job shifts, home repairs, opportunities, real estate deals, side hustles. 2026 advice, UBS/JP Morgan, keep 3 to 5 years of spending in liquid assets to avoid selling stocks in dips. Too much cash, inflation erodes it, even at 5% yields, after taxes approximately 3 to 4% real. Too little, forced sales kill compounding. Goal: tiered buckets, safe/liquid for 1 to 3 years, semi-liquid for growth, core invested for max returns. Strategy number 1, build tiered cash buckets. Don't dump everything in one spot. Tier 1, immediate access, 0 to 6 months expenses, high yield savings accounts, HYSA. Top rates January 2026. Varo/Adelphi approximately 5.00% APY, Axos approximately 4.31%, Quantic/Openbank approximately 4.10 to 4.20%, FDIC insured, no lock-in. Apps: Ali, SoFi, Capital One for easy transfers. Tier 2, short-term buffer, 6 to 24 months, money market accounts/funds. Rates approximately 3.90 to 4.10%, Quantic 4.10%, Vanguard fee, MFXX/VUSXX approximately 3.6 to 3.65%, 7-day SEC yield. Check writing/debit access, slightly higher yields than some HYSA. Tier 3, opportunity/emergency, 2 to 5 years. Keep here for big moves without touching stocks. This gives instant liquidity while earning 4 to 5%, way better than 0.01% checking accounts. Strategy number 2, use CD laddering or short duration bonds for locked-in yields without full illiquidity. Laddering CDs. Buy 3-month to 5-year CDs at staggered maturities. For example, $10,000 each in 6 months, 1 year, 2 years at 3.50 to 4.78%. When one matures, reinvest or use cash. Beat single long CD if rates fall. Access portions regularly versus HYSA. CDs lock rates, good if rates drop, but early withdrawal penalties. In 2026 falling rate environment, per some forecasts, ladder for flexibility. Alternatives, Treasury bills via Treasury Direct, approximately 4% short-term bond ETFs, for example, Vanguard BSV/SHY, approximately 3 to 4% yield, liquid daily. This adds predictable income/growth edge over pure cash while keeping most accessible. Strategy number 3, hold growth assets in taxable brokerage accounts for easy access. Unlike 401k/IRA, penalties before 59.5, taxable accounts, Vanguard/Fidelity/Schwab, let you sell anytime. Pay capital gains tax only on profits, 0 to 20% long term. Invest in low-cost index ETFs, VTI/VOO, total market/S&P 500 for approximately 7 to 10% historical growth. Keep 20 to 40% in short-term bonds/cash equivalents inside brokerage for buffer. Tax loss harvesting. Sell losers to offset gains. Reduces tax hit when accessing funds. This gives liquidity and growth potential. Sell small portions in bull markets to refill cash buckets without derailing compounding. Strategy number 4, automate rebalancing plus use low-cost borrowing lines, annual rebalance, sell high-growth assets to refill cash buckets, harvest gains. Portfolio lines of credit/HELOCs, borrow against investments/home at low rates, approximately 7 to 9% instead of selling, defer taxes, keep growth. Use only if return greater than interest. Roth conversion ladder. If early retirement goal, convert traditional to Roth gradually for penalty-free access later. Combine 60 to 70% invested growth, 30 to 40% liquid/semi-liquid, adjust based on risk tolerance. Risks, over liquidity, cash drag in bull markets, opportunity cost if rates fall, taxes on taxable sales. Mistakes, all in HYSA, miss growth, ignoring FDIC limits, $250,000 per account, panic selling growth assets. 2026 tip, rates may soften, lock some now via CDS/ladders, but stay flexible. Simple plan to start, assess needs, calculate 3 to 6 months expenses to target Tier 1 HYSA, open at Varo/Ali for 4 to 5%. Build Tier 2, move next buffer to money market, Quantic/Vanguard, ladder or bond ETFs, open treasury direct or brokerage for short CDS/bonds. Taxable growth, fund brokerage with 5,000 to 10,000 plus arrow by VOO/VTI, set auto reinvest. Automate monthly transfers to refill buckets, rebalance yearly, track, use personal capital or empower for net worth/liquidity view. Start small, even $500 per month split between HYSA and brokerage builds both. In 2026, build liquidity and growth with tiered cash, laddering, taxable brokerages, and smart access. Don't sacrifice one for the other. You can have safety, flexibility, and compounding. If this helped, like, subscribe, notifications on. Next, best taxable brokerage strategies for 2026. Comment. Which strategy are you trying first? HYSA bucket, laddering, or taxable growth, or your biggest liquidity goal? I read everyone. Stop choosing between safe and growing. Do both. Take action this week. See you next time.